Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Already 14 problems I have completed on consolidated balance sheet in holding companies. So my regular viewers, if I've already watched those 14 problems, definitely you got a good command on how to prepare the consolidated balance sheet. What are the different issues in making the consolidated balance sheet? So if you have not watched the earlier videos, you cannot be able to understand if you join in between. So if you want to do the complete command, watch the video from beginning. First video I have given on introduction part. What is a holding company, what is subsidiary company, what is consolidated balance sheet, how to make the consolidated balance sheet by applying the provisions of AS21. All these things I have explained in the earlier videos. So if you have not watched the earlier videos, please go to the playlist of my channel. Select the subject Advanced Corporate Accounting and select the topic holding companies. Watch the first video, get a command and in knowing what are holding companies, how to make the subsidiary companies, then only you can understand now. So if you want the complete grasp of the subject, watch the video in continuity, first, second, third, like that. If you join in between or you skip in between, you cannot be able to understand. Hope you got my point. So now I'm going to start the next problem, that is problem number 15. But before starting the problem, I expect my viewers to have a printout of the problems which are given in the link under my description. So before start watching this video, take a printout, keep it ready, the problems. The 15th problem I'm reading out. The following are the balance sheets of H Limited and S Limited as at 31st March 2002. So H holding company, S is the subsidiary company. The two balance sheets are given on 31st March 2002. H Limited acquired 70% shares of S Limited on 30th June 2001. Our year ends on 31st March 2002. And holding company has purchased the shares on 30th June 2001. So how many months post and how many months pre? We have to find out. So post acquisition. So 30th June 2001. That means we start from July. July, August, September, October, November, December, January, February, March. So totally 9 months are post-acquisition. 9 months are post-acquisition and 3 months are pre-acquisition. So whatever profit earned during the year, we divide the total profit into 3:9 ratio. 3:9. So 3 by 12, 9 by 12. So 3 by 12 profit is pre-acquisition profit, capital profit. And 9 by 12 is the post-acquisition profit, that is the revenue profit. That point you remember. On 1st April 2001, beginning of the year. On 1st April 2001, General Reserve, Profit and Loss Account and preliminary expenses of S Limited stood as 90,000. Beginning of the year, 1st April. General Reserve shows a balance of 90,000, Profit and Loss Account shows a balance of 30,000 and preliminary expenses shows a balance of 9,000. Preliminary expenses is a fictitious asset. It will be deducted. It will be deducted. So any profit, any reserves before acquisition is a capital profit. Is a capital profit that should be considered while calculating goodwill or capital reserve. Next, now balance sheet is given. Share capital, shares of rupees 10 each, 9 lakh rupees in H Limited. No adjustment, directly 9 lakh rupees will be taken in consolidated balance sheet. And 3 lakh rupees is there in S Limited. Subsidiary company, 3 lakh rupees share capital, out of which 70% is held by H Limited, 30% is held by outsider, minority interest. General Reserve 2,25,000 H Limited, 1,05,000 S Limited. Now, carefully you see. General Reserve at the beginning of the year, 1st April. On 1st April, General Reserve was 90,000. On 31st December, General Reserve was 1,05,000. So 15,000 rupees General Reserve increased during the year. During the year, General Reserve increased by 15,000. Now, and profit and loss account end of the year 75,000. How much is the profit at the beginning of the year? Here it is given 30,000. The P&L account shows a balance of 30,000 at the beginning of the year. And end of the year it has increased to 75,000. So from 30,000 to 75,000. 45,000 rupees profit earned during the year. Now, creditors, simply we have to add up the creditors. Unclaimed dividend in S Limited. In S Limited, there is unclaimed dividend, and this unclaimed dividend will be added to minority interest. First time we are coming across this point. The unclaimed dividend in subsidiary company should be taken under minority interest. Then fixed assets, simply we add up. Investments. Now investments are given in S Limited. Shares at cost 3,90,000. This is the value of investment. Then current assets are 4,20,000, 3,43,500, and preliminary expenses 9,000. Next page it is given. Prepare the consolidated balance sheet of H Limited and S Limited as on 31st March. Not much adjustments are given. There are no intercompany debts, no unrealized profit, nothing. So comparatively very easy problem. The only thing you have to find out the revenue profit and capital profit. And the capital profit will be considered while calculating goodwill or capital reserve. That's it. Now consolidated balance sheet of H Limited and its subsidiary S Limited on 31st March 2002. Equity and liability. First of all, we draw the complete format of the balance sheet according to Companies Act 2013. So before making the calculations, first of all, we have to make the blank balance sheet, format of the balance sheet. Equity and liability, shareholders fund, share capital, then reserves and surplus. Minority interest, 1, 2, 3, note number 1, note number 2, 3. Then non-current liabilities are not there. Then current liability, trade payable, fourth note, short-term loans and provisions we don't have. Simply for the sake of formality, we are writing the item. We don't have the amount. Total. Then non-current assets, fixed assets, tangible, intangible. Non-current investments are not there. Current assets, inventories, trade receivable, cash and cash equivalent, other current asset. In almost every problem we will have all these current assets, but in this problem we don't have any inventory. We are not given any inventory. We don't have any trade receivable. We don't have any cash and cash equivalent. Only we'll have other current assets. That's it. The blank balance sheet we have drawn. Now come to the working notes. That is very, very important. So you must focus, you must concentrate more on working capital. Working notes. Now first working note, H Limited share 70%, minority interest 30%. First point. First point. Second, date of acquisition is 30th June 2001 and the date of the balance sheet is 31st March 2002. So how many months are pre? April, May, June. Only 3 months are pre-acquisition. Post-acquisition, 9 months. So post-acquisition period 9 months, pre-acquisition period 3 months. Second calculation. Third calculation, profit earned during the year. Just now I told you the reserves at the end of the year is 1,05,000. At the beginning of the year, reserves were 90,000. Beginning of the year 90,000, end of the year 1,05,000. How much reserves have increased? 15,000. So increase in reserves by 15,000. Similarly, profit and loss account. The profit and loss account balance at the beginning of the year is 30,000. Whereas end of the year profit and loss account is 75,000. So how much increased? 75,000 minus 30,000, 45,000. So increase in reserves, increase in P&L account, total increase 60,000. This is the profit earned during the year. Now this profit will be divided between pre-acquisition and post-acquisition. Pre-acquisition period 3 months. The pre-acquisition profit is 60,000 into 3 by 12, 3 months. So it comes to 15,000. Post-acquisition profit, that is revenue profit, 60,000, 9 by 12, 45,000. So we have bifurcated. This post-acquisition profit is a revenue profit and this pre-acquisition profit is a capital profit. Now capital profit, we calculate what is the total capital profit. All the profit and reserves before acquisition, that is called capital profit. Now first of all, reserves. Reserves on 1st April 2001 given in the problem 90,000. That is capital profit. Similarly, profit and loss account on 1/4/2001 30,000. This is also capital profit. Current year's pre-acquisition profit here. Pre-acquisition profit of current year 15,000. That is also capital profit. The total is 1,35,000. Apart from that, we will have a capital loss, that is realized preliminary expenses. Preliminary expenses. So deduct preliminary expenses 9,000, we'll get capital profit 1,26,000. Now this 1,26,000 capital profit will be divided between H Limited share and minority interest. 70% of this 1,26,000 will go to H Limited share, and 30% of 1,26,000 will go to minority interest. That's it. Now we'll calculate the goodwill or capital reserve. First of all, investments made by H Limited in S Limited. How much investment cost? 3,90,000 given in the balance sheet. Investment made by holding company in subsidiary companies, 3,90,000. From this we deduct two items. Paid up share capital. The paid up share capital is 70% of 3 lakh. 3 lakh rupees is the share capital of S Limited given. 70% is invested by H Limited. So 70% of 3 lakh, 2,10,000. Share in capital profit, just now we have calculated. Share in capital profit is 88,200. 88,200. Add up both, 2,98,200. Subtract 3,90,000 minus 298,200. 91,800 is the goodwill. And this goodwill will be taken under intangible assets in the consolidated balance sheet. Now last and final item, minority interest. In minority interest, we take 30% of paid up share capital, share in capital profit, share in revenue profit, and lastly unclaimed dividend. These are the items we will take under minority interest. First of all, paid up share capital, 30%. 30% is of minority interest. So 3 lakh into 30%, 90,000. Secondly, share in capital profit. Here capital profit we have calculated. Minority interest share is 37,800. Share in revenue profit. Revenue profit is 45,000. The profit after acquisition. Here you have calculated. Post acquisition profit is the revenue profit. Post acquisition profit 45,000. 45,000 ka 30% will go to minority interest. So 30% of 45,000, 13,500. Last one, unclaimed dividend, 7,500. Add up 1,48,800. This is the minority interest. That's all. All working notes completed. Now notes forming part of financial statements. First note, share capital. The share capital of holding company, only holding company. So 90,000 shares of rupees 10 each given in the problem. In the balance sheet, same share capital I am taking. So 9 lakh rupees is the share capital number 1. Second, reserves and surplus. So this reserves and surplus, we take the general reserve P&L account of holding company as it is, H Limited. So general reserve of H Limited 2,25,000 as it is I have taken from the balance sheet. P&L account of H Limited 1,05,000 as it is I have taken. Now share in revenue profit. Share in revenue profit of S Limited. So S Limited revenue profit is 45,000. 45,000 is the revenue profit. Out of 45,000, 70% belongs to H Limited. So 70% of 45,000, 31,500 is the revenue profit getting from S Limited. So total is 3,61,500. This is the reserves and surplus. 3,61,500. Next ones. Minority interest, already we have calculated 1,48,800, take it minority interest. Then accounts payable, trade payable. Trade payable will take creditors, no adjustment, nothing. Only creditors of H Limited, S Limited we add up 2,17,500. Total of the liabilities over 16,27,800. Now we'll come to asset side, tangible assets. Here fifth, tangible fixed asset. So H Limited assets, S Limited tangible assets add up 772,500. No adjustment, nothing. Intangible asset, goodwill. Already goodwill we have calculated here, 91,800. So 91,800 is the intangible asset goodwill. Now lastly we have other current assets. So you can see here other current assets are H Limited 4,20,000, S Limited 343,500, total 763,500. No adjustment, nothing. So take the total 1627,800. So this is the end of problem number 15. Come on, now we'll start the next problem. Problem number 16. H Limited acquired 80,000 shares of 10 each in S Limited on 1st October 2007. The summarized balance sheets of H Limited and S Limited on 31st March 2008 is given below. So 2 points. First point, H Limited holding company, S Limited subsidiary company. The holding company holds 80,000 shares. 80,000 shares. So totally how many shares are there? Balance sheet share capital in shares of rupees 10 each. S Limited 10 lakh rupees. So total equity share capital in S Limited is 10 lakh. So 10 lakh divided by 10, 1 lakh. So total number of shares in S Limited is 1 lakh. Out of 1 lakh, 80,000 shares are purchased by H Limited. So remaining 20,000 shares are purchased by outsider. So simply we can say 80% shares are purchased by H Limited, 20% shares are purchased by outsider. Second point, the balance sheet date is 31st March 2008, but the shares are purchased by H Limited on 1st October 2007. So how many months pre and post? October, November, December, January, February, March. So these 6 months are post. The first 6 months are pre. So in the current year 2007-2008, first 6 months pre-acquisition, next 6 months post-acquisition. This we require for dividing the current year's profit into pre-acquisition profit and post-acquisition profit. The pre-acquisition profit is capital profit and the post-acquisition profit is the revenue profit. The balance sheet share capital in shares of rupees 10 each, 20 lakh H Limited and S Limited 10 lakh. Profit and loss account is given 50,000 H Limited, 45,000 S Limited. Reserves 1 lakh H Limited, 1 lakh 50,000 S Limited. 9% debentures 2 lakh rupees in S Limited. This is the first problem where we have debentures also, non-current liability. The debentures we have only in subsidiary company 2 lakh, right? Next, bills payable and creditors. These two we combine to make trade payable. Now, goodwill. Goodwill is already existing in H Limited. So this will appear in intangible asset. Machinery, furniture, these are tangible fixed asset. We add up both. Shares in S Limited 8,80,000. This is the investment made by H Limited in S Limited. 8,80,000 is the value of investment. Then stock given, debtors given, bills receivable given, cash given for both the company. 9% debentures in S Limited 80,000. 80,000 rupees invested by H Limited in S Limited's debentures. So actually total debentures in S Limited are 2 lakh. Out of the 2 lakh rupees of debentures of S Limited, 80,000 debentures are held by H Limited. Again, it is an intercompany debt. It is intercompany debt because debentures are issued by S Limited and these debentures are purchased by H Limited. Purchased by H Limited, 80,000. So only outside debenture holders that will be taken. Out of 2 lakh rupees debentures, deduct 80,000 intercompany debt and only 1,20,000 we will show debentures, long-term bonds. That is the new point. Then bills receivable of S Limited include 8,000 accepted by H Limited. Bills receivable of S Limited includes 8,000 bills which are accepted by H Limited. The bill is drawn by S Limited and accepted by H Limited, intercompany bill. So this 8,000 rupees will be deducted from bills receivable and also from bills payable. And creditors of S Limited include 20,000 due to H Limited. The creditors of S Limited includes 20,000 rupees which are due to H Limited. Again, it is intercompany debt. So this 20,000 will be deducted from debtors as well as creditors. Intercompany debt. So in this problem we have intercompany bill, intercompany debt. The bill is 8,000. So 8,000 rupees will be deducted from bills receivable and bills payable. 20,000 rupees will be deducted from sundry debtors and sundry creditors. Then an amount of 30,000 was transferred by S Limited from current year's profit to reserves. Current year's profit to reserves. So actually reserves, the total reserves are showing 1,50,000. 1,50,000 rupees is the reserves of S Limited. And adjustment, it is saying 30,000 rupees have been transferred from current year's profit into reserves. Current year's profit into reserves. So we'll deduct the 30,000. We want how much is the reserve before transferring. So out of 1,50,000, we'll remove 30,000. And only 1,20,000 is the reserves before acquisition. Right? And that 30,000 will include during current year's profit. Prepare consolidated balance sheet. That's it. Now, see carefully. Consolidated balance sheet of H Limited and its subsidiary S Limited on 31st March 2008. First, we draw the complete format of the balance sheet. Equity and liabilities, shareholders fund, share capital, reserves and surplus, minority interest, non-current liability. In this problem, we are also having non-current liability, that is debentures. Then trade payable, other current liability we don't have. Then fixed assets, tangible 6, intangible 7. Non-current investments are not there. Inventories, trade receivable, cash and cash equivalent, other current asset. Blank balance sheet you have to draw first according to the format given by Companies Act 2013. Now note number 1 to 10. 10 notes we have to show. Notes forming part of financial statements. But before preparing the notes, first we have to do working notes, making all calculations. First, share of H Limited. Totally 1 lakh shares are there in S Limited. Already we have decided, because in the balance sheet it is given share capital 10 lakh and the face value of each share is 10 rupees. So 10 lakh divided by 10, you will get 1 lakh. So out of 1 lakh shares, 80,000 shares are held by H Limited. So 80,000 by 1 lakh into 100, that comes to 80%. 80% is the share of H Limited in S Limited and 20% is the share of minority interest outside. Right? And date of acquisition is 1st October 2007. Date of balance sheet is 31st March 2008. So how many months pre and how many months post? 6 months pre, 6 months post. Now second working note. Current year's profit. Current year's profit. See the profit and loss account, how much balance is given in S Limited. In S Limited, profit and loss account balance is 45,000. Profit and loss account balance is 45,000 and reserves are 1,50,000. So current year's profit 45,000 will take, and in adjustment it is saying that from current year's profit 30,000 rupees have been transferred to reserves. Now we'll bring back the 30,000. Because from current year's profit we have transferred. How much transferred? 30,000. So that 30,000 and this 45,000. Profit and loss account balance is showing 45,000. So this profit and loss account balance 45,000 plus 30,000. 75,000 is the current year's profit. Current year's profit. Now current year's profit 75,000. First 6 months profit pre and second 6 months profit post. So half of 75,000. 75,000 ka half, that is 37,500. So 37,500 is the pre-acquisition and 37,500 is the post-acquisition profit. Post-acquisition profit. Next working out capital profit. Now reserves of S Limited. S Limited balance sheet shows 1,50,000 reserve, but in that 1,50,000 it includes 30,000 we have transferred from current year profit. So that we deduct because we want the reserve before transferring from profit. So 1,50,000 minus 30,000, 1,20,000 is the reserve. And pre-acquisition profit. Current year, first 6 months profit is pre-acquisition profit. First 6 months profit how much? 37,500. 37,500. So total capital profit comes to 1,57,500. So this capital profit we divide, 80% goes to H Limited, 20% goes to minority interest. So 80% of 1,57,500, 1,26,000 is the share of capital profit of H Limited. And 20% of 1,57,500, 31,500 is the share of capital profit of minority interest outside. So we have calculated the capital profit. Now minority interest. In minority interest, we include paid up share capital, share in capital profit, share in revenue profit. First of all, paid up share capital. 20% of 10 lakh rupees. The total share capital in S Limited is 10 lakh. So 20% of 10 lakh, 2 lakh. Share in capital profit, just now we have calculated. Share in capital profit is 31,500. Share in revenue profit. Revenue profit means post acquisition profit. The post acquisition profit is 37,500. So 20% of 37,500, 7,500. So minority interest comes to 2,39,000. This is all working out we have prepared. Now goodwill or capital reserve. First of all, investment of H Limited 8,80,000 given in the problem balance sheet. Asset side it is given. Investment of H Limited is 8,80,000. From this we deduct two items: paid up share capital and capital profit. Paid up share capital is 80% of 10 lakh. The total share capital of S Limited is 10 lakh. 80% is held by H Limited. So 80% of 10 lakh, 8 lakh. Plus share in capital profit. Here we have calculated. Share in capital profit is 1,26,000. So 1,26,000, add up 9,26,000. So here 8,80,000 minus 9,26,000, you are getting negative figure. Negative. So negative means capital reserve. So we are getting a capital reserve of 46,000. Now we'll come to the notes. Over. Working notes completed. Now we are coming to the notes forming part of financial statements. In this note number 1, share capital. We'll take the share capital of holding company H Limited. जैसा problem में दिया same, exactly same I'm taking. So 2 lakh shares of rupees 10 is 20 lakh. So here you can see consolidated balance sheet note number 1, 20 lakh rupees the share capital. Next comes reserves and surplus. Reserves and surplus, first of all we take reserves and P&L account of H Limited as it is. जैसा balance sheet problem में दे दिया same. In the problem, balance sheet, the share capital is given, reserves are given, P&L account of H Limited 50,000, reserves of H Limited 1 lakh. So H Limited reserves and P&L account exactly as it is. Now revenue profit. Revenue profit from S Limited. So how much is the revenue? Revenue profit is post acquisition profit. How much is the post acquisition profit here? 37,500. So 80% of 37,500. 80% of 37,500, 30,000. This goes to H Limited. So total will be 1,80,000 is the reserves and the surplus. You can see it. 1,80,000 reserves and surplus. Third, minority interest here. Third point is minority interest. Minority interest 2,39,000. 2,39,000. Next, non-current liabilities. Non-current liability consists of long-term borrowings. In long-term borrowings, 9% debenture. H Limited, we don't have any debentures. S Limited, 2 lakh rupees debenture. So total debentures are 2 lakh. Out of 2 lakh rupees of debentures of S Limited, H Limited holds 80,000 debentures. 80,000 rupees worth of debentures. So S Limited has issued the debentures and H Limited has purchased the debentures. It is intercompany. Intercompany debt. So 80,000 will be deducted. The outside debenture holders are only 1,20,000. So 1,20,000 will be shown. Non-current liability. That is a new point. First time we came across in this problem. Now trade payable. Trade payable consists of creditors and bills payable. So here you can see trade payable, creditors. In the balance sheet, in the problem, you can see liability side creditors, H Limited are 4 lakh, S Limited are 2 lakh, total creditors 6 lakh. Now intercompany debt. In the adjustment, it is saying 20,000 rupees are due by one company to another company. S Limited is having a debtors of 20,000 which has to be received from H Limited. So it is intercompany debt 20,000. Deduct 6 lakh minus 20,000, 5,80,000. Similarly, bills payable. The bills payable of H Limited and S Limited 20,000 plus 10,000, 30,000. Now in adjustment it is given that some bills are drawn by one company and accepted by another company. Intercompany bill, that will be eliminated. So how much? 8,000 rupees are drawn by one company, accepted by another company. Deduct 22,000. So total is 6,02,000. This is the accounts paid. Over. We have completed all the items of the liability side. 31,41,000 is the total of liability. Now we'll come to the assets. Tangible assets. Here you can say tangible fixed assets, machinery. Simply we have to add up the machinery of H Limited, S Limited, 5 lakh plus 4 lakh 50,000, 9 lakh 50,000. Furniture, H Limited, S Limited, 20, 40, 60,000. Total 10 lakh 10,000 is the tangible fixed asset. We have taken 10 lakh 10,000. Intangible asset. Intangible asset consists of goodwill. So already in the problem in balance sheet, it is given goodwill 1 lakh rupees in H Limited. So here you can see intangible asset, goodwill of H Limited 1 lakh given in the problem. Now when H Limited has purchased S Limited shares, there is no goodwill. If we have got goodwill here, that goodwill and this goodwill would be added, will be added. अगर यहाँ पर goodwill आता तो ये goodwill और पहले का 1 लाख रुपए goodwill दोनों goodwill को add करते थे. But we are not having goodwill. We are having capital reserve. Opposite of goodwill, capital reserve. So this capital reserve should not be taken under reserves and surplus. If we don't have any goodwill, अगर ये goodwill नहीं रहता, if there was no goodwill earlier, then this capital reserve would have been added in reserves and surplus. But when we are having goodwill, so this capital reserve should be deducted from goodwill. Should be deducted from goodwill. So 54,000 rupees we should show as intangible asset. Goodwill will be 54,000. Next, non-current investment not there. Inventories, 8th item. Inventories, simply you add up the stock. Stock of H Limited, stock of S Limited, 11,70,000. No adjustment, nothing. Then next one is trade receivable. Now you see inventories. Inventories we have added. Now trade receivable consists of debtors and bills receivable. Exactly, already we have done in the previous problem also. Debtors we add up. H Limited debtors 180, S Limited 270, total to 450. Now intercompany debt. 20,000 rupees are intercompany debt. That should be deducted from creditors and also from debtors. So here 20,000 rupees we have deducted from creditors. Where is it? Here. 20,000 rupees we have deducted from creditors. Same 20,000 rupees we have to deduct from debtors. So 4,30,000. Bills receivable. So add up the bills receivable of H Limited and S Limited, 10,000, 15, 25,000 minus intercompany bill. One bill is there, 8,000 rupees. This 8,000 rupees common bill will be deducted from receivables, bills payable and also from bills receivable. So we have deducted 8,000, 8,000. 4,47,000 is the trade receivable. Next one is cash and cash equivalent, last and final item. The bank balance of H Limited and S Limited both added together 4,60,000. 4,60,000. That's all. Your balance sheet is tallied, 31,41,000 tallied. Over. So this is the end of problem number 16. So hope my regular viewers genuinely interested in learning the subject got a good command by watching these videos on how to make the consolidated balance sheet. If you are unable to understand any point, rewind the video. Again you watch the video. If you watch the video some 2-3 times, definitely you will get the grip on the problem. You will find it more interesting. You will get confidence in solving the problem on consolidated balance sheet. Okay, if you are satisfied with my lecture, give a like to the video. Share it in your friend circle groups. Give your comments. And lastly, don't forget to subscribe the channel. We'll continue the next problem in the next video.